Here's a question, and I'm asked about this a lot. Why do regional centers give such low return on investment? Why is that? Is it greed? Is it because the Fed rate is at an all-time high? Banks are lending at an all-time high. Why is it that the regional centers don't give good returns on investment in a debt-based model?
I'll take that question, and then I unfortunately need to jump to another meeting. But we have to understand how EB-5 works. The reason it works is because funds that are raising the capital are going to be contributing the capital to a developer at a rate that's somewhat similar to what a senior lender would give, but much better than mezzanine financing or a typical preferred equity investment. And so there's a limited amount left there, right? Spread. So we're capped at what that amount is, number one. Number two, the fund expends a substantial amount of money in order to put together the fund. I mean, talk about paying lawyers like us in order to structure the deal, paying broker-dealers to bring in the investors, ongoing maintenance of the fund for the next 8-9 years, taking measures to do quarterly reporting, annual filing reporting. There is a substantial amount of money that's being spent. And even if the fund raises, let's say $100 million in one fund, they're easily spending 3.5% on an annual basis to maintain all of these things I just mentioned. Beyond that, they're going to pay the investors some amount, right? 0.5%, which seems to be the norm. Sometimes you get 1%, whatever that norm is. And then they have a little bit left in the pie. I mean, why else are they doing this work if they're not going to make money off of it, right? So they do need to make some money. But what I can tell you, having represented so many funds and so many different regional centers, yes, they make a good chunk of capital, but they're not taking home 10%. It just doesn't happen, right? At the end of the day, they're taking home a much smaller amount. And for the amount of work they do, it's something they've definitely earned. So that's usually what I tend to tell investors, number one. And number two, think about it this way. You're investing for immigration purpose. This is not a typical private equity investment. This is a non-traditional private equity investment. You're not going to earn the waterfall distribution if you were to go in a different type of project. That's not what this is structured to be. If you were going to do that, there are lots of other deals out there, and that's what you need to pay attention to. But in order to make something that is attractive to the developer, where the developer understands what they're paying for and they've got a set amount that they're paying on an annual basis, this is the only way it's going to work.
Thanks, Rohit. So, I mean, just to clarify a few things about the expenses related to an EB-5 investment, and Rohit touched upon the numbers a bit. So, and this is related to third-party independent regional centers that fund projects. The typical cost of raising capital is about 2 to 2.5%. Other expenses takes it to around 3%, around about that. And then these loans are given out at about, say, between 5 to 7% to the developers. So it leaves 4%, out of which typically half to 1% goes to investors. So regional centers are making about 2 to 3% on the loan they're forwarding to the project. It is not like it's being loaned at 12%, investors only get 1%, and the regional centers are making 10% on that. Now, of course, and Nima can shed light on this, it's a risk to reward. There are equity and preferred equity models, and just based on their ability to provide you returns. I mean, Nima, could you shed light on the debt and equity models?
Yeah, well, I think, both you, Abhi, and Rohit did a great job of explaining. I think, most of our investors are attracted to projects based on the name and track record of the developer. They don't necessarily give much thought to why a developer, especially a well-known one, would be willing to do EB-5. If you're a well-known developer and you can borrow money from the bank at 5%, and once you strike that loan deal, all that money is available day one, that's pretty significantly different than going to a regional center, striking a deal at 5%, and the regional center saying, well, we need to find interested EB-5 investors. It may take us 1.5 years to get the money, right? So why would that be attractive to a developer? And then the answer becomes, well, because you're cheaper than a bank. And so they're willing to take on what is deemed to them a complication of EB-5 because the money is cheaper. So If you're doing cheaper money and you have to raise it, there's just not a lot left to pay everyone, especially if you're doing a debt deal. If the loan is set at 6% and you have 4% of cost, well, that's 1% is left over to pay investors, right? If you look at equity, equity is different. There's what's called common equity, which means that you are generally uncapped or have a higher cap in a return of your capital. And then there's preferred equity, which means you get a guaranteed return rate at a specific number. That is typically in either equity scenario more than you would receive as a debt investor, but it carries more risk because debt is always paid off first before equity is paid off. So if you go into a project that has a senior loan, a construction loan, preferred equity, and then common equity, if you're common, those 3 layers above you need to be paid off first. But because you're willing to take on that risk, your returns are often higher. The one thing to be cautious of is when you come as an equity investor, and this is true of many EB-5 projects, not all, but many, you are coming in as common equity, usually to get enough equity into the project to secure a senior loan. So you as an equity investor are not only taking on the risk of the project's ability to go vertical, achieve the asset value projections that they're making so they can sell or refinance and pay you off, but you're also taking the risk that they are good at raising EB-5 money. And so you may find a project that you like. The project, for all intents and purposes, may be amazing, but the regional center is just not good at raising EB-5 money. And a year goes by and you get a phone call or an email that says, hey, we couldn't raise enough EB-5 money to get a senior loan. And as such, we're shutting down the project and returning you your money. So you didn't lose any money, but you lost a year on your timeline. Instead of having the green card in your hand in 2 years, now there may be a backlog because you're an Indian national, and now your wait is 5 years. So again, you really need to consult your attorney. You really need to have open and transparent conversations with the regional center because not all projects are designed equally. Not all equity is equal. Not all debt is equal.
Makes sense. Thanks, Nima. That was a great answer.